Boop boop bop boop bottom bum. Boop boop bop boop bottom bum. Da 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 bottom bum. Beep bop boop bop boop bop boop da bottom bum. Beep bop boop bop boop 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 bottom bum. Okay, folks, welcome to our discussion of stock valuation. This is the second video on this subject. Last time we actually did some valuation based on what securities analysts called fundamental analysts. How they value stocks. We're going to continue that today and get into a little bit more theory and describe the justification for our generalized recommendation on the whole. There are always exceptions to every rule, but by and large, that it's better to buy and hold and invest for the long term than to try to time the market and pick individual stocks and make a lot of money on one individual stock or things of that nature. Okay, so like I said, the last time we engaged in the analysis that fundamental stock analysts would engage in, and we basically came up with two types of formulas that they use, and these are they get increasingly sophisticated, the formulas, but trust me, these are sort of the bare bones formulas that are used, and as I said in that video, the point that we have to always remember is that when we're talking about fundamental securities analysts, they basically have to project out infinitely into the future, 30, 40 years from now, theoretically, what the income is going to be for the company. And it's based on that that they value the stock. Now, of course, stocks are set by supply and demand in the market, on the New York Stock Exchange and whatever, NASDAQ and wherever. But securities analysts, the people that advise institutions and the people that advise individual investors, use formulas, and they're fairly sophisticated, but they're basically derived on these two fundamental formulas right here. I'm not going to, we're going to avoid the proof right here of why. work. But if we were to take, for example, one formula, this is to determine the expected value. This, what a securities analyst would say a stock is worth. Now, if it's worth on the stock market, if the price is higher than this value, securities analysts would say, don't buy it. If the stock on the stock exchange was priced at a lower price than this, they would say buy it because the stock is actually worth more than that. So this is really their attempt to come up with what's known as intrinsic values. That is not what the stock market price is, but it's based on these valuations of the stock price or the company's value that they make a buy or sell recommendation. In any event, we pointed out last time that one of the problems that fundamental securities analysts had was basically they have to have a crystal ball and calculate, for example, the free cash flows, FCF is free cash flows, of a company into the infinite future. Okay. We also pointed out that dollars received 100 years from now can almost be ignored simply because we did the present value proof and showed that those dollars aren't worth that much anyway. But bottom line is, let's look at these formulas. We pointed out in that video two very important facts, that this R right here in this WACC, R is involved in this WACC, and it's actually an important component of this WACC here. But this R right here is the required rate of return on the stock. In other words, this is the return, like 20%, 15%. 10%, whatever the percentage is, the required percentage rate of return that an investor is going to require on the stock. That's what that R, that's what they expect to make in percentage terms. And this R is very related to interest rates generally. Now this is a very important fact. This R, here's the formula. This is what's known as the capital asset pricing model, securities market line. Formula for determining the required rate of return. It's the risk-free rate plus the generalized rate on the market generally minus the risk-free rates times this thing called beta. That's beta. The all-important beta that we're going to talk about. Beta. Which is the systematic risk that all stocks face. All right. But we pointed out that this risk-free rate is related to the Treasury bond rate. You know, and it's called risk-free because we don't expect the federal government to default on its bonds. And now you can use the 1-year Treasury rate or whatever Treasury rate you want to use, but most people, I think, I don't know, that the 10-year bond rate is the rate that is most, a longer-term bond yield is more like what the stock market's going to require because stocks are generally supposed to be held for longer term. All right, that's a more complicated subject. But anyway, so here it is. You're going to, interest rates that investors require on their return on their stock is related to the risk-free rate plus some, this is a premium, what's known as a market premium right here. Okay, this number right here times beta. Okay, so, and I pointed out, I believe, that for that reason, if interest rates start to rise, that means required rates of return are going to start to rise because of this formula. Okay, because if the risk-free rate goes up, this number here, this whole number here is going to go up. Okay, and that way, and if that happens, if this number down here starts to go up, guess what? The price of the stock, the value of the stock to the stock analyst as he's looking at it, that stock's worth less if interest rates start to go up. It's very important. Now here's an interesting factoid. Right now we're about 30 days into the Trump administration, and he's talking about a lot of things. But But coincidentally with all this, for the last year, there's been speculation that the Fed would increase interest rates. Well, if the Fed increases interest rates, guess what? That should push this rate up here, and that should push stocks down. But guess what? We're in the midst of a big rally. So does that make all of this a bunch of foolishness? Well, you know, while it is mesmerizing, I think personally that this is evidence of something that's known as the workings of the efficient market hypothesis, because even though no legislation has been passed yet, and the passage of it, some would probably say it's probable, and you know, not just speculation, but President Trump is talking about a new tax code with lower tax rates, which would push up free cash flows of companies. Now, it hasn't been enacted yet, but he's saying we're going to push up the profits that companies make, the free cash flows, and that might make dividends bigger too, probably would, because the companies are making more money, right? And we're going to cut regulations, which also should help companies be more profitable. So while the Fed is talking about increasing this, Trump, if his policies go through, should increase this stuff. Hasn't happened yet, but this is what the efficient market hypothesis is all about. Now I will tell you, having taught some courses on this and gone to business school and get my MBA and all that kind of stuff, that that the efficient market hypothesis is very popular, I would say, amongst most professors, college professors. Now there are disbelievers, the people called the behavioralists. They don't think it. They think the market is more or less run by a knee-jerk reaction of fear and greed and herd mentality and a lot of other influences. I don't think that that's necessarily inconsistent with what the efficient market hypothesis says. But the efficient market hypothesis says that the market will virtually instantaneously discount, and that's in other words, in this context, it really doesn't mean discount the way you think about it. It means it takes into account, the market immediately takes into account what it expects will happen, which will be, in this case, the market already expects and has taken into account in all stock prices that we're going to have lower tax rates under President Trump and less regulation, which should increase free cash flow, which should increase the value of companies. So anyway, that's my slant on it, and that's the way that would work. But here's the deal on the efficient market hypothesis. It basically goes to this idea. Most college professors will tell you that technicians, nice people, but past results of stocks and looking at charts and things like that is not predictive of what's going to happen in the future, and that stock movements are in many senses random, and they cannot be predicted by looking at charts. So most academicians would not go this route. They sort of, they're more in this camp, but they sort of meld over into the efficient market hypothesis also. They see the value in trying to do this analysis because fundamental security analysts, they're smart people, they're very smart people. But who has a crystal ball? You got to be more than smart to have a crystal ball. I mean, you got to have a crystal ball, and nobody has a crystal ball. So anyway, the idea is that you can't, there's three forms of the efficient market hypothesis. I'm not going to go into all of them here, but basically the efficient market hypothesis, this one especially, which is probably adhered to by most people, is that except for inside information, which you cannot trade on under the law, you cannot, except only insiders have enough additional information that's not public to know enough to be able to have a better shot, an even Steven shot at beating the stock market, or maybe slightly better than even Steven shot to beat the stock market. Everybody else cannot beat the stock market because every piece of information in the world that's available, publicly available especially, is already in the stock, and you cannot guess which way the stock is going, and that they will say, and with a lot to back it up, that studies have shown that not even the most successful mutual fund managers, not even the most successful stock pickers can end up beating, on a risk-adjusted basis, just a random picking of stocks, throwing darts at a dartboard approach. It's basically because it's too much crystal ball oriented, and no human being has a crystal ball. So they say the only thing that affects stock prices really is unexpected news. That's the only thing and who knows what the unexpected is? The unexpected cannot be expected because it wouldn't be unexpected then, and you can't know the unexpected unless you have inside information and use it, which is illegal insider trading. So anyway, that is the basis of the efficient market hypothesis. It says you can't beat the market, that stocks have a tendency to be random, and the reason that they are random is because they move on the basis of unexpected information. Okay, so going back and just sort of highlighting some past information. As risk goes up, so do rewards. That's both profits, but also the possibility of big losses. As risk goes down, potential rewards go down, as do the potential for losses. All right. Basically, the capital asset pricing model says that you should not buy an individual stock because I'm going to spare you the details of all the studies and all that kind of stuff. But this stuff is a stock's total risk, which affects risk and reward, has two elements: unsystematic risk and systematic risk. Unsystematic risk is company specific and is unique to the company or to that stock. Systematic risk affects all stocks generally. You cannot eliminate systematic risk because it affects all stocks generally. It's the market risk, the generalized market risk. If you had two companies, an oil company and a truck company, I'll show or demonstrate, I think, what company-specific risk is if you had an oil company and a truck company, and if oil prices went up, that might be positive for the stock value of the oil company. It might be negative for the value of the truck company. So you'd have two companies affected totally differently, one going up and one going down. That's because their company-specific risk related to oil prices would be different for the two companies. But the problem is if you just bought the oil stock or if you just bought the truck stock, you would be buying both types of risk. But guess what? If you put these two companies in a portfolio together, the risk of one goes up, the risk of the other goes down, and you can eliminate this risk, the unsystematic risk. Some people sometimes call this alpha, and this is our beta. It's the systematic risk, okay? But you can eliminate that if you get a portfolio of both stocks. Spare you a lot of details. If you buy enough stocks and put them in a portfolio, you know, say of 40 stocks, you can virtually eliminate all unsystematic risk, and your portfolio of stocks would only have the systematic risk. And that's why this formula down here only has beta in it and no alpha. There's no alpha in here, in this formula, okay? So that's the reason for that. And like I said, if you just buy a stock by itself, you're paying for both types of risk. You don't have to do that. And that's why it is better to buy in portfolio. Now there are funds out there, index mutual funds like that are reflective of the of the S&P 500, and some even that reflects even the world view of foreign stocks are included. And those kind of funds where the fund assets themselves are not actively traded. In other words, you don't pay a lot of management fees. They just buy and hold those stocks all in direct proportion to the S&P 500. In other words, you're buying the stock market generally. But that is, and if you do that, guess what? This fund would have a beta equal to 1.0, which is the average of the stock market. Some stocks, if you were to have a smaller portfolio of just two stocks, so let's say this oil company stock had a beta of 2, and the truck company had a beta of 5, and you put an equal amount of money into each, that's the important part. It has to have an equal amount of money into each. Then what's that? That's 2.5 divided by 2. So the beta of that would be the beta of your two stock portfolio would be 1.25. That means it would be it would be 25% more volatile. It would give you 25% more potential rewards than the stock market generally, and 25% more potential losses. But that would be a lot less risky than if you just owned the oil stock, which has a 2, because it would have twice as much potential reward, but twice as much potential loss. Plus, if you just bought the oil stock, you would also have the unsystematic risk. Okay, so each stock has its own beta. And when you compute the stock's required rate of return, you stick that figure, whatever that is, 1.5, 1, or 2, or you might have a beta of 0.87, you know, or some other number. You'd stick it in here, you'd figure out your 10-year risk-free rate. If the risk-free rate is, on the 10-year bond was 4%, if this was 4%, and if the return on the stock market generally was 12%, minus 4%, so that would be 4 plus 8, and if your beta in this case, let's say it's the oil company stock, was 2, that would be 16 plus 4. Your required rate of return for that stock, this R, would be 20%. Pretty hefty. Okay, all right, so that sort of is the sum and substance of the efficient market hypothesis, and it sort of forms the theoretical. I would just say this: that generally speaking, when I was a stockbroker many moons ago, you know, I saw a lot of this stuff firsthand. And the market moves so fast; it takes no prisoners, and just on the basis of the speed with which prices can adjust, I I sort of became a believer in this theory. While I do believe that the behavioralists do have some points to be made here with fear, greed, and all that other stuff, and the technicians pick up on this a little bit, I think that by and large, over the long run, and if you give stocks a chance over over any kind of period of time, that this stuff begins to fade. I'm not going to say it's irrational or irresponsible, but I think that's my own personal opinion. But like I said, there are studies that have called into question whether this beta analysis is correct. But like I said, the studies also show that over the long run, it is not many, if any, really, investors in the long run, year in, year out, decade in, decade out, can pick stocks and beat the market. In any event, I'm David Lentz, and I think we've covered everything, and I want to thank you all for coming on by, and I will see you next time at reasonandbalance.com. Thanks.
Boop boop bop boop bottom bum. Boop boop bop boop bottom bum. Da 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 bottom bum. Beep bop boop bop boop bop boop da bottom bum. Beep bop boop bop boop boop bottom bum.